right, good morning, good afternoon, and good evening, wherever you are listening to. Here is a Fabian Econom. I want to take you on the basics of Forex. Forex. Okay. Um, so many people have been talking about forex. I've been talking about forex, and some people are still doubting the fact: is forex real? Is forex legit? Is forex a scam? And the rest. I want to say that forex is not a scam. Forex is real, and I've been in this business since 2012 until date, and you know I don't see anything, scam about it. And I knew that it was even here before I started it. So before I become a trader, the forex was also in existence before now. So some people are still doubting whether it's real or not, whether it's scam or thereabout. So and because of this, some really want to know what is forex, what it's all about, why is it that some people do loss from the market and do this and that. So that is what I'm going to take you through. And in all the series of this you know um, tutoring and this coaching, you have to learn a lot on how what is forex, who trade forex, how does it work, and the rest of them as it has to do with forex. So first of all, I want to start with what is forex. Now, uh, what is forex? Okay, now when we are talking about forex, you know that this is combination of two words. Now this FOR stand for foreign, and this EX stand for exchange. So the full meaning of forex means foreign exchange. Foreign exchange. Now, when we are talking about foreign exchange, we are talking about exchanging currency, exchanging currency. You know what happened is that actually the currency always fluctuates. Currency fluctuates naturally. It fluctuates. Like let's say Nigeria, for example, 2015. By then, about $1 was about 379 naira. 379 naira. But due to the economic changes and climbing unemployment rates and some government policy bringing in of treasury single account and the rate of things, policies of the government, and the economy of the nation, start crashing, and the currency kick off. And we now have about $1 becoming 400 and something naira, and so on and so forth. And now in 2019, we had of COVID-19, and because of that, everything crashed down. And now here, 2021, we are having $1 now to become about 500 and something naira these days. So these are some of the factors. So which means let's assuming now that in 2000 and 2000 and let's say 2015 2015 2015, and this is 2021. Now that 2015, let's assume as a trader. Okay, now you are not even trading. You just say, let me just deposit money into my forex account. Let me just deposit how much? Let me just deposit $2,000 into my account. Now, um, $2,000 by then was about around 600, 600 and okay, around 7. During 2020, 2015, $2,000 was approximately 750,000 naira, and you just okay, I'm not trading anything, let me just deposit, and you deposit this amount. Now, as time goes on, you just forget about the account, and 2021 you're like, wow, let me go and check my account, let me just go and see what is happening, let me withdraw. Now currently $1 is about 510 naira. Now 510 naira per $1. So now in this case, if you are going to withdraw this 2,000 naira dollar that you deposited into your forex account without trading, without even doing anything, how much are you withdrawing here? Now 2,000 times the current value, the current value of the naira now will give you 2,000 times 500. This will give you about 2,200,000 naira. So imagine, see what you have now minus this this okay, that will give you 1 million. Yes, 1 million, 1.2 million. Now in this case now 1.2 minus this 750, you see what you have. Like you have about 450,000 naira gain profits, like on without trading anything, just for the value of the currency to increase. So it's all about buying and selling of currency. When we are talking about forex, it's all about buying and selling of currency. And now, how does it work? How does it work? Okay, so now okay, I've talked about what forex is, trading of currency, and now currency. This time around, when we are talking about forex market, we are talking about buying or selling of currency, and not food at this point in time, but something like they were talking about money at this point in time, and not just um any other thing now. So now I talk about exchange. I talk about changing in value. Now we have here to be the stock exchange market that is regulating all these financial activity. Remember that forex is the biggest money market in the world currently, where trillions of dollars are being exchanged over time. So now we have here to be the stock exchange market now, and we have here to be an individual, that is you as maybe a newbie or forex trader. Now be the forex trader. Now we have this we have this to be the value of the currency you are changing the money to. Now we have here now to be a middleman. Now remember, as you are traveling, let's assume somebody wants to travel to United States of America now, and as you are traveling to United States of America, um, you cannot use naira to buy something in UK or in USA. Now you must change the value of the currency to what they are using over there. And now let's assume this is a Nigerian traveling to USA, and in this point he have naira here, and he or she needs to get dollar. And as he is going there, he must do what he, what goes up must come down. And if you are traveling to a particular place that's not your domicile, that's not your permanent address, you come back to your home address. Now, as you are going, This young man here is a middleman that will do the exchange. And now we call this young man the this is the broker, the one that is doing the work, exchanging direct from he gets it direct from the stock exchange market. He gets it in bulk and sell a bit to you, change it. Now, as you come to this place, you will change it. And now, as you are also coming from here to this side, you also have to change it here when you reach here. And as you are changing any value of money at the initial, as you are coming back, you cannot change let's say the same value again, because every time now and then the money is either valuing or devaluing. It's always fluctuates. Now in this case, what do? People now utilize this opportunity to make profits. It was done manually before now, but now since everything virtually has gone online, now business is online, everything buying this and that, everything is now online, investment, stock, and the rest of them online. So this one also comes in online. So in this case, when you now buy this, coming back, you get this amount. There is a difference. There will be a difference between the amounts that you collect. Now, the individual here will charge commission. Now, here we don't call it commission, we call it spread. Spread. Remember, I said that currency, we are trading currency, and now when you are trading currency, it comes in pairs. It comes in pairs. I will still analyze that in another clip. And this base can be something like USD, JPY. Now, US dollar, Japanese yens. You can have euro, US dollar. Now, in this case, if you are exchanging euro for this, now you will see a price. You know, you see something like, let's say this. You see 1.0012, and in this other side, you see 1.0 016. Now, the difference between this, if you say this minus this, we have the ask and the bid price. Now, the bid price and the ask price. Now, what do you mean by ask and bid price? Now, when you are asking and when you are bidding, you know what it means. Like someone just going to the market to bargain, and someone say, "I'm selling my clothes for 5,000 naira. This clothes is 5,000 each." That's what he sells, and probably that is ask price. And you now say, "You're not selling this amounts," so which means you are trying to beat the price in this other place now. But in this case now, the ask and the bid price now is like, okay, I'm coming here to buy clothes from you, and you buy the clothes 5,000 naira. After buying the clothes 5,000 naira, and you know the person say, okay, this clothes I'm selling 5,000. You are buying 5,000. You went home with it. Maybe peradventure you wore it, let's say 1 week, and something happened. You are in want and you are in lack. You are in need of money. You are like, please, I'm sorry. The clothes I bought from you, I don't want to wear it again. I'm just having a little challenge. I want to sell it off. Maybe peradventure this period now, the clothes you bought is now very expensive, that is no longer in the market, and people are looking for such clothes. And young man said, okay, this clothes I'm going to buy it from you 5,200. And you are like, no, the market, the clothes is valuing and not the value it is valuing, and I want to sell it 6,000. So sorry, I'm buying it 5,500. That is what I'm buying. So now that is the amount he's willing to buy it again back from you. That is what you call it. the bid price nowadays. While the other one, in some other time you may come, as you come around, maybe already there's material, he have it enough. He say, no, in fact, I have enough. You say, please, can you just buy it 5,000? Let me just get, say, no, it's 4,500 I'm going to buy from you. 4,000. Now, the difference between that amount now remember that in this case now you have already made loss. But the difference between the two of them now, in this case, is what we call the spread. The amount that, you know, the spread now here is the spread now is the one that he directly quotes in the stock exchange markets, and the one that he is willing to sell, for you at that particular time, and the one they are selling at that particular time in the foreign exchange, and the amount that he's willing to buy it from you at this particular time. I remember now that nobody wants to buy and make loss. So even if they are selling let's say 120 in the forex in the stock exchange market, and he wants to buy it from you, if they are selling 420, he wants to buy it from you, he may buy from you 400 or 370. So that difference now is his gain. So the same thing here. The broker, the difference between the ask and the bid price is what we call spread. That is what we call spread. The broker's gain. The broker's gain. So the broker have nothing to lose. It has nothing to lose. So it's for you to know how you play your own, how you do your own, and you work it out, and you make your money. Now, so here you now know that currency comes in pay. You know that we have what we call ask price and the bid price. You know what it means. Now let us further to lot size and leverage. Let us talk about leverage and lot size. This is another vital topic that I'm going to still broaden in the next study, but I just want to do the very first aspect of it. Okay, so we have something that we call a margin. We have leverage. We have lot size, and all these some of the terms used in foreign forex market. What do you mean by um, lot size? Lot size. Now remember, it is a unit of the size of your capital that you wish to use in initiating a trade or placing an order. Let's assume somebody have $100, and now he wish to initiate a trade. Now you want to trade, and in this case, how are you using the whole $100? You know what it means for you to use the whole amount to trade. That it's risky. If you happen to lose, you lost everything. You lost everything. So you determine your lot size, the unit of your capital, the unit of your equity, the unit of equity you wish to put into the trading. So sometimes we have minimum lot size to be 0.01. 0.01. And in this case, any pip, depending on the currency, a pip can give you 0.0 something or 0 point something. But the higher the lot size that you use, the unit of your capital, remember, the higher the profit or loss that you make. Now, when you are talking about profit in Forex, don't forget to talk about the loss. Yeah. So the higher the lot size, the higher the profits and loss made. Now, why is it good for a trader to try to minimize the lot size he or she is using for his trading? Remember, this man is using 0.01 standard. This one is using 0.10, and in the same account, if they initiate a trade at this point in time, this one may happen to see something like minus 0.25. 0.25. That is the spread of the broker. Now, while the other person now sees minus um, minus 2.50. You get it? Just let's assume this is just 2 pips, and this one is seeing 2.50, while this one is 0.25. Now, this trade is, let's say, plus or minus, is in favor of both of them, and both of them are using $100 um, as an equity to start, but different lot size. Now, what will happen is the market appreciates 50 pips, 50 pips, okay? And let's assume that this standard now, like that 1 pip is equals to this 0.25. So the market has appreciated in 20, okay, let's say 20 pips. So this young man will have this times 20, will give him 2 times 10 will give him 2.5. So times 20, this times 20 will now give him $5, while this young man is having plus $50. Wow, isn't that great? Wow. And adding to his equity is now 150. This is great. And his equity here is 0.15. Do you get the clue? You get the whole thing now. Now, this one now is having 0.5, and this one is having 150. Ah, wow. So that means just in a day, have been able to make half of my my capital. This is great. This is wow. This is wonderful. So, assuming the market was so favorable that the market went in their favor to 40 pips. 40 pips. Yeah. In that case, that means this young man or young lady will make plus $100, while this woman will make only $10, making this one to be 110, and this one making this one to be 200. Wow. So this is great. 200, and just a day, as in like just a day, I've been able to double my account. This is wow. I think if I would be able to get like this, double my account every day, that means I will make a whole lot of money, a whole lot of money all around. So in this case now, what do you do? What do you do in this case? Ah, okay. Let's see. In this case, um, let reverse be the case. Let's see what will happen. Both of them initiate the trade, and as a novice, none of them remember to put stop loss. Yeah, and it happened that as they initiate the trade, after the analysis, their phone went down. They used phone in trading, and their phone went down, and there was no source of electricity, and there was a very important news, maybe non-farm payroll, or let's say Joe Biden's speech, or any other important news that is capable of affecting the economic, the foreign exchange market. And this trade have to go down, let's say 40, let's say 30 pips. It happened to go down like 30 pips. If it comes down 30 pips, what do you expect? Oh my God. So what you expect from here is this young lady will have minus 7.5, while this one will have what? Minus 75. Minus 75. Wow. So you get it. So how much is remaining? Ah, 25. 25. While this one now is still having about 75. Huh? No, not 75. Sorry. 90. Okay. 92.5. Is it have 92.5? Yes, of course. And remember, with this, you can still put 0.01 again or 0.02. While this one now cannot be able to put this, place this order again. Yeah, can't place again because his capital is not up to again, cannot carry such trade. So if he try to execute trade, they will say insufficient. So you get the point now that um it is very, very important. It's very, very important to notice, to take note and cognizance of the lot size and the lot size when you are trying to trade. Yes, if you really want to maintain, if you really want to stay in the market, because this business is consistency. There's a day that you can, make loss, and but the next day you cover it up. You cover it 20% or 100% of the losses, or 200% of the losses the next day. So it's all about all you do. And sometimes you may just happen to just make a little loss, close it and replace the trade or change the direction. Yeah, you make profit. But if you go it this way, let's assume, okay, now let's assume on a normal, yeah, the both of them, they made a very good analysis, and the analysis was that the market is going to buy is a bull. So when I talk about bull, is means that the market is buying. So if I talk about bear, that means the market is going down and selling. Now in this case, now let's assume the market is bull and the market is buying, and you're like, okay, it's true, the analysis was perfect and okay, like it was okay, but a little, in business, in this forex, there's something that we call noise in the market. Sometimes there may just be a swing, little swing and swing and swing. Maybe sometimes the trend may want to gather some momentum. So, so I'm coming back to this. I'm coming back to this momentum of a thing, guys. When I'm explaining the candlestick, you will get it. Something like this. Something like this. Okay, something like hope you are getting me. Yeah, something like, let's say, yeah, these candlesticks now. Now, sometimes this stand for sale while this is for buy, and you see what the market is still doing. Do you see what is happening here? And now with the next one, you now see something like, do you get the whole thing now? Now, the two of them, the both of them, they enter the market here at this point. The analysis was okay and perfect that the market is going to buy.